some people
Okay,
in there.
we're live. All right, thanks everybody for showing up. This is yet another platform test for us. This is a live stream through Teams that we're doing. So welcome to the weekly roundup live stream. I'm just going to bring Ben in here and we'll get started. You're good to go there.
All right.
Yeah.
Hey, how's it going?
Good.
Excellent.
So, I'm a little distracted today because this platform has got a lot of things going on to
New
it.
parts, yeah. Well, we're trying to get it to work properly, just like we want it to, and it takes a few steps for us to get there. So
exactly,
certainly bear with us as we get into the view where the other system we're using just wasn't working because it's pulling everybody up into the system, and that's not ideally what we want. So we want to continue to protect everyone's privacy. So we switched over to this live version, and take us a couple of times, but we'll be up to full speed before I know it.
100%.
Yeah.
All right. So why don't you let us know what happened this week? It was a bit of a bloody week in the markets.
Yeah. Well, end of August, as we started work our way through September with the rate announcements, I think most of the attention was with U.S. Central Bank on Wednesday of this week with their rate announcement. A lot of volatility around it for sure. Where what did Powell say? Not anything really specific, except for he didn't raise rates. Really didn't change his stance too much. Some people think he said that he's done raising rates. Others think that he's not done raising rates. So we had a lot of volatility associated with that. And yesterday we saw a pretty volatile down day for pretty much every asset class, with the exception of US dollar. We've seen oil continues to be quite volatile through here and up around its 52-week highs right now. So yeah, lots of things going on, but central bank got most of the attention this week, and the Bank of England also got quite a bit of attention because they had an inflation number come out on Tuesday this week that was weaker than expected. And, coming into that inflation number, something in the neighborhood of 80% likely they were going to raise rates on Thursday this week. Because inflation was softer, they did not raise rates on Thursday. So you had the sterling fall on the back of that. So central bank land all week.
All fun.
Yeah.
Interesting things.
Yeah.
Okay. Well, what do you got for slides for us here? I'm gonna send this live.
Yeah. Okay.
Okay, so I think this part will work well.
Okay.
There you go. You're live.
All right, super. Well, we're just going to add the disclaimer into the mix here. This is not to be intended as investment advice. Speak with the licensed advisor if you have any questions. Let's jump in. A bunch of things to go through. I got a couple of comments on just what's going on with individual stocks, and I think last week Ed made a couple of changes, so I just want to provide a quick update on that. But as we look around the world, Canada and the US specifically, because that's very relevant to what we are doing, it says less disposable income, fewer diners out. So this is Open Tables data, pretty good and interesting, worth paying attention to. Obviously, I'd wish that Ottawa was in here, but it wasn't added to the list yet. But Toronto, obviously a big driver of Ontario's revenue. We see that we're down kind of 10% year over year. If you look at Edmonton, similar, about 7-8%. The only place in Canada that's been slightly positive is Vancouver right now. And so, the less money in people's pockets as a result in less money spent by the consumer, rolls over to be less economic activity. So that continues to be the direction that I think things are going. So lots of things to pay attention to. I don't know how worthwhile these charts are because sometimes, you can look backwards. This one's from 1793. Jim Bianco, great data, good research, worth paying attention to. So as I have conversations with people just about the bond market, I think it is interesting to go back and look through different periods because the current environment that we have right now, which is interest rates or rising to try to combat inflation. It's not something that we've seen in the last, about 40 years. So it's worth taking a stretch back to think about what could potentially happen coming from here. And so if you look at the kind of the 1841 period, which is the last time we saw bonds down this much, we had 2 negative years in a row. And then obviously, if you look at the other side of that, up 50%. These other periods of time that you look at in the 30s, similar drawdown, followed by 5 years of significant upside. Again, in the 80s, where we saw quite a bit of volatility around inflation and interest rates, you had big swings again, down years followed by massive up years. So as we look back at 22, obviously bond markets performed very poorly. This year is off to a very difficult start still as well. And so when we think about where we are at this point of the cycle, I think it's worth paying attention to what's the best risk reward. And, I think we're probably splitting hairs around whether they raise interest rates one more time or not. I think it's pretty irrelevant to what happens over the medium term. So still think that, so you got a great risk reward with bonds here. Had a good conversation with the portfolio manager today as well that we'll hope to get out shortly, just around what's going on in the markets in the world. So continue to go with that. As we look around the world, though, I think there's a lot of things to continue to pay attention to. One of them is the massive influence that China continues to have on the world. If you look at what's been happening with the Chinese economic data, had a really nice run and move out of end of last year into the start of this year. Around April timeframe, it looks like we probably peaked from a data perspective, and the markets did as well there. And then we've seen a correction up until about 2 weeks ago, where China started to stimulate. And then if you look at what's happened since then, it looks like they're starting to reaccelerate. So as we think about the impacts that they have on the world, right now they play a pretty outsized impact. Why I thought this chart was interesting was just the amount of EU-China vehicle trade. And so vehicle trade continues to accelerate quite quickly. If you look at this, 412,000 vehicles exported from the EU to China in 2022, kind of $25 billion worth, and 561,000 vehicles imported into the EU from China. Interesting. So just as you see the numbers and the size that's happening with the China and the rest of the world from a trade perspective, I think this is interesting, and we should continue to pay attention to it. So just one piece here, a little bit more of a fun piece, was that TomTom has some research and data just to think about what's happening in your city. So this is Ottawa data. And so you can look at any place around the world effectively, except for China, that you're interested in seeing what it's like. But, as I look at it, you look at TomTom comes up with some recommendations and kind of the worst time to be driving in the city. So Thursdays from 4 till 5. And then it comes out with, as you think about ESG and working from home and those kinds of things, they put out a data set, which is interesting. It says, if you work from home 1 day a week, Thursdays, you save yourself 25 hours of commute time, $150 of gas, and 150 kilos of CO2. And then it spits out what happens if you work home Thursdays, Wednesdays, Tuesdays. It's a 76 hours a week savings, $341, and for about 450 kilos of CO2. So interesting as I looked at the different cities around the country, Thursday afternoons tend to be the busiest period for what reason, I don't know exactly, but it seems to be the case. So as you think about the commute, this is interesting data that TomTom has put out there for us. That's it from the charts today.
Okay, we're back here. Bear with me. Bear with me. No. Oh, you can hear me though, right?
Yeah, I can hear you okay.
Okay, let's just go with that for now. Oh, there we go. Okay. Okay, yeah, those super interesting charts today, Ben. Good job. All right, so let's jump right into what we're looking at for next week.
I'd say just before we wrap one thing up, last week I'd said that I had on Thursday last week I had sold any of the Amazon exposure we had and went to some T-bills. I bought half of that position back yesterday. Amazon was down about 12% from where we'd sold. So bought some of that back, half of that back yesterday. We'll see what happens next week. If it continues to come down a little bit further, may add the whole position back to it. But reasonable correction in that space. Really, tech got hit in the last 5-6 days based on really kind of what's happening in the world. So what's up for next week is we are end of September, so we'll be watching that as we come into month end. But it's been a challenging equity and bond market, so we'll be seeing what happens after this week. Typically been lots of volatility around central bank meetings, so we'd be I think it'd be a quieter week next week, but continue to watch what happens from here. Gentleman we spoke with today from EHP was talking about how he thinks we're in kind of the quad 2, which is a kind of a reacceleration of things for the next couple of weeks to a month. So it'll be interesting to see if his thesis is right, because a bit of a conflicting view with what Keith thinks is happening in the world.
Gotcha.
Yep.
Okay. No questions on the Q&A that I can tell. And any parting words?
No, I think that's great. We're if you need anything, let us know. Continue to reach out and provide updates on what's going on as we get into the end of the year here. A couple of months left. Starting to look at gains, losses, and switches and things like that. So if you need anything, have any questions, feel free to book a meeting and or give us a call, and we're happy to have a discussion.
Great. Perfect. Well, that's it for us. Have a great weekend, everybody.
Thanks, everybody. Take care.